Okay, let's take a look at what we have here. Arnold Industries has pre-tax accounting income of $40 million, so we got that. The tax rate is 40%. Okay. The only difference between accounting income and taxable income relates to an operating lease in which we are the lessee. The inception of the lease was in 2013, and a $20 million advanced payment was made at the beginning. So for us, because we're the lessee, this is prepaid rent. A $20 million advance payment is tax deductible in 2013, but for financial reporting purposes represents prepaid rent to be recognized equally over the 4-year lease term. So 20 million divided by 4, we're going to pick up 5 per year in rent expense. So we have these payments and the tax related to those. So the total deferred tax amount is 8 million. Yeah, I guess 8 million. And that's a deferred tax liability, okay? Because we're subtracting that whole 20 right now. And we're going to pick it up over the period of 4 years. So this year, our total tax payable, 40% of the 20, is 8, and the deferred tax liability is the other 8. So, given that, let's do the journal entry. Income tax expense, 16. Deferred tax liability, income tax payable. Okay? So let me scroll that back so you can see what I just wrote. So that's the first piece. That's where we need to be. So I think that's pretty straightforward, okay? Now, we come to the next year. And the next year, they tell us prepare the appropriate journal entry to record Arnold's income taxes for 2014. Pre-tax accounting income was $56 million. That's what that number is. So, we have $56 million. Plus, remember, we're picking up 5 for the deferred tax liability. So we're picking up that $5 million of deferred income that we picked up. So we have 61 million altogether times 40%, and that comes up to 24.4 mil. Okay, so that's that piece. So the 24.4, because remember this is tax rate times taxable income. The taxable income is increased by that 5. So that's our income tax payable, 24.4. Now, of that 24.4, some of that is income tax expense. Some of that is the use of picking up that deferred tax liability. Well, there's a couple of ways you can do this, okay? I'm lazy. I'm simply going to take the 40% of the 5,000, or the 5 million, excuse me, and that's 2. And I'm going to have the income tax expense, the remaining 22.4. You can also take 40% of 56 and come up with 22.4, and 40% of 5 and come up with 2. Any way you like to do it, as long as you come up with those numbers, okay? Now, the last scenario it gives us, it says, but wait, there's more. suppose that a new tax rate was enacted in 2014. Let me bring this in a little bit for you. New tax rate was enacted in 2014 that causes the tax rate to change from 40% to 30% beginning in 2014. Well, remember what we did, we were originally carrying, at the beginning of the year, we had 20 million in here at a 40% tax rate. So we were carrying $8 million as a DTL at the beginning, okay? Now, during the year, we used up 5 of that, so at the end of the year, we had 15 million. But the tax rate going forward is changing to 30%. Okay? So 30% of that is 4.5 million. So that's the ending. That's the DTL at the end. So altogether we have a change in the account. It has to go down. The DTL has to go down by 3.5. So let's take a look at what that does. Remember, our income at the beginning of the year was the 61 once we adjusted it, because that's what we had done before. We had the 56 plus the 5. And the tax rate attached to that was 40%. So that was the 24.4. We just did that piece, okay? That's this year's income tax payable. But we have to now take into account, we have to adjust for this. We have to reduce our deferred tax liability by 3.5. So we have to reduce our deferred tax liability by 3.5. Our income tax payable is still 24.4. That's what we're going to write the check for, but our income tax expense now goes down to 20.9. So it really isn't all that difficult. You just have to remember the order, and you have to remember how the pieces fit together.